Welcome, and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the File folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. We're now ready to begin. Thank you.
Welcome and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. I'm Pam Amato Demagayas, moderator for today's webcast. Before we begin the presentation, I'd like to introduce today's presenters, Sasha Correnti and Roos. Sasha has practiced public accounting since 2004 and focuses on performing financial and A133 audits for not-for-profit and life sciences organizations. Along with providing accounting and consulting services, Sasha has significant experience conducting audits in accordance with governmental auditing standards and the Single Audit Act. Laura has more than 20 years of experience providing accounting and auditing services for not-for-profit clients specializing in audits of universities, research institutes, arts organizations, foundations, and other not-for-profit organizations. She currently serves as a member of the FASB Not-for-Profit Advisory Committee. So with that said, I'm going to turn the webcast over to Laura to get things started.
Thanks, Pam. We are so excited to get things started this morning. We're going to start off with our first of our 4 polling questions. That gives us a little information about who you are and what type of organization you're coming from. So let us know if you're a foundation or other type of grant-making organization, a higher education institution, social service organization, a research institution, or a trade association, or if you don't fall into any of those buckets, something else. Give you just another second. I hate for you to miss this, the easiest of our 4 questions today. All right, great. Let's see. Well, it looks like we have a mixture, a little bit of everybody, a little low on the Research Institute side or the trade associations, but we're really glad to have you today, and we will get things started. So So over the next 50 minutes, we are going to go over the exposure draft update, that the responses that the FASB's received to the proposed standards. We'll review some recently issued standards. Those are the ones that we've picked out to talk about today. Spend a little bit of time on the uniform grant guidance and then some other projects that are going on at the FASB. So the FASB issued their exposure draft on these changes for not-for-profit organizations, and they received 260 letters in response to the exposure draft. I think that was more than they were expecting to get, and so it's been keeping them busy. Here is a summary of the different folks that responded to these letters. 51% of them were from preparers, so folks like you preparing financial statements at the end of each year. 34% of the respondents were from audit firms or accounting firms, most of them working with not-for-profit organizations or even some retired partners. And then there were some responses from a variety of other individuals, including state societies, trade associations, and a few folks from academia. As you can see from this slide, colleges and universities by preparer type provided the most number of responses, followed by healthcare providers. They also had a lot to say about this standard, and then some voluntary health and welfare organizations made up the next largest group. Overall, their support for this project, so the feedback that the FASB received was, hey, it is time to probably look at our current model being used for financial reporting. And there was some support to keep consistency within the various subsectors of the not-for-profit industry. So colleges and university financial statements should look similar to other colleges and university financial statements. However, their financial statements wouldn't always look like those of a church or a trade association or a social service organization or even an arts organization. We would expect them to look different, and just due to the nature of their operations. And in the healthcare arena, it was really important to those that responded that their financial statements be consistent with similar for-profit entities, because they often compare themselves to those types of organizations. In addition to that, there's a strong desire to have consistent reporting for for-profit entities, as many users of not-for-profit financial statements have their backgrounds reading for-profit financial statements. So having different rules for not-for-profit financial statements can cause some confusion, and it may make the financial statements less understandable to the users, which wasn't one of the FASB's goals. They really wanted the financial statements to provide the best information and to be more understandable to the users of the financial statements. So the comment letters also expressed a desire to retain flexibility, which would allow different subsectors to prepare their financial statements in a manner that would mean the most to the users of their financial statements. In addition, it's important to have a standard that can be adjusted to apply to organizations of all sizes. You can imagine in our industry, we have really small organizations and then really, really substantial organizations. And so being able to be flexible in how the standards can be applied and still be useful. Many of the letters also express concerns about the amount of time and resources that would be needed in order to implement the standards as they are currently drafted. I can imagine you can feel that in your organization. The first area related in their proposal, there are about 5 or 6 different key concepts related to net assets. And you'll remember the exposure draft proposed to reduce the 3 categories of net assets down to 2. The classes would be called net assets without donor restrictions and net assets with donor restrictions. And in addition, the exposure draft would require some additional disclosures if you had board-designated net assets. And so more disclosure than what's currently required around those types of designations. The feedback that the FASB received are these provisions of the exposure drafts are probably the area that got the most favorable feedback because it's really believed to increase simplicity. of our financial statements. Many believe that the distinction between temporarily restricted and permanently restricted net assets was often not well understood, so if we eliminated that distinction, it might be helpful or more understandable to the users of these financial statements. However, there were some that did not agree with the proposal and felt that the distinction between permanently and temporarily restricted are fundamentally different, and the net assets should not be combined, so not everybody's in the same boat. In addition, there were others that really feel strongly about the distinctions in net asset classes and thought that how they are classified, or even the board designated amounts, needed to be reported on the face of the financial statements versus one of the proposals was, hey, can we just include this information in the footnotes? And really thought that many users don't get to the footnotes, and so thought the distinctions between different restrictions, restricted and unrestricted net assets, needed to stay on the face of the financial statement. Another goal of the exposure draft was to improve the disclosures and presentations related to liquidity in our not-for-profit financial statements. In response, the exposure draft requires disclosures of quantitative and qualitative information in the footnotes to the financial statements. Some of those, the items on the screen here are what the proposed standard would require. The feedback for the liquidity disclosures is mixed. Generally, there was more support for the qualitative disclosure requirements related to liquidity and establishing reserves versus the qualitative or the quantitative disclosures. Those that disagreed with the disclosures were really concerned that the requirements are vague and too subjective and would not be comparable between entities. In addition, the information may be outdated by the time the financial statements are issued. You'll remember you needed to determine your period of time, 30, 60, 90 days. Another concern in this area also relates to the concepts of the proposals. It not only relates to this concept, but to a couple of the other concepts that were put forward by the FASB, that why should not-for-profit organizations have different disclosure requirements than for-profits? Currently, there's no similar requirements for for-profit organizations to disclose this type of information, but many do require a classified balance sheet. And then finally, there was some concern that the time and effort to prepare these disclosures and have them audited would be greater than the benefit of the disclosures themselves. FASB is considering other alternatives because there's still a belief that better disclosure around liquidity is necessary. One alternative is to require a classified balance sheet, or to break out assets whose use is limited in the face of the balance sheet, so showing those restrictions right there on the face. The healthcare industry group does this really well using these net assets, or the assets whose use is limited in their financial statements. So there's some guidance there. The third goal of the exposure draft was to provide information in the statement of activities to help evaluate the financial success of the organization for the year. FASB developed an intermediate measure that would be the same for all not-for-profits based on their definitions of mission and availability of resources. So using these two terms, you'd look at your income and your expenses, and you'd either put it in operations in your operating measure or not, based on these categories, the mission or availability. The feedback the FASB received in this area was also mixed. There was positive feedback about the requirement to use an intermediate measure of operations. Many thought that was really important. And quite a few subsectors of our industry group actually do this already, although it may not be consistently applied. However, there were many that disagreed with the concepts put forward in the exposure draft. The respondents provided a number of recommendations to the FASB, which included the standard, hey, leave it the way it is. Let organizations design their own operating measure that works best for them, and then perhaps really strongly encourage preparers to use one, but not require it. Or to go back and have the FASB relook at their term mission. Most people or respondents didn't agree that investment income and the quasi-endowment allocations wouldn't be included in operations, and really struggled with that. There was also a lack of support for the two different subtotals. You'll remember in our previous discussions where there are the subtotals for before transfers and after transfers, and many of the respondents thought that was confusing and not very useful. The respondents disagreed that the standard the FASB really thought, hey, we should make all not-for-profits comparable and be able to look at a financial statement from a university and compare it to a food bank. There was their original kind of thought. So not-for-profit organizations could be compared internally. But it's not really what the feedback is that they got from the general public. And so they're re-looking at how we can use an operating measure just to be more specific to subsectors within the organization. The transfers, as it relates to the transfers in the statement of activities, there was overall disagreement that these amounts should be shown on the face of the statement of activities. The respondents provided a number of alternatives to the FASB to consider during their redeliberation process. One approach is to only include program service income and the related expenses in their operating measure, and contributions and investment income would stay outside of an operating measure for all organizations. Or another idea was that all internal transfers would just be disclosed in the footnotes and taken out of the statement of activities. Finally, another suggestion they received was to limit the transfers in the statement of activities to only those that are board approved. For example, designations for endowments. I expect the whole operating measure concept that was provided in the exposure draft will probably need additional time for the FASB to evaluate and may get put on a back burner so they can more fully vet some of the ideas and suggestions that they've received and what's going on in the for-profit world too. The fourth concept in the exposure draft related to functional expense. So there was support for not-for-profit organizations to include expenses by natural classification and functional allocations. Most respondents thought that this could be disclosed in the notes to the financial statements versus adding a requirement to have a statement of functional expense for all organizations. But of course, there were some who disagreed. Some believed that the time required to prepare this information would outweigh the benefits, and it might not be very useful for very small organizations, or even for organizations that aren't significantly funded with contributions, may not be as useful. And some also had concerns with the differences between how functional expenses are reported in the 990 and then how they might be required to be reported for GAAP purposes. And then of course there was a group that said, hey, leave things as they are and let it be optional. Except for perhaps those voluntary health and welfare organizations that have the requirement to include a statement of functional expenses now. The final area in the exposure draft relates to the statement of cash flows. The exposure draft would require not-for-profit organizations to prepare their statement of cash flows using the direct method. This provision received mixed feedback. Many respondents stated that the direct method is more understandable. In addition, responders to the proposal that use the direct method actually said, hey, once you get it set up and going, it's not that bad. It doesn't take any longer, but the setup time to get your cash flow statement converted to the direct method would take some time. However, most of the respondents opposed the direct method for a variety of reasons, even though it might be believed to provide more information. Generally, the financial statement or the statement of cash flow is underutilized in the not-for-profit industry, so why make changes to it? Even though most respondents agree the direct method provides better information, there's not a consensus that the direct method is better or superior to the indirect method. There's also a belief that not-for-profit organizations should have the same options that for-profit organizations have. So as long as for-profit organizations have the opportunity to choose, that same option should be available to not-for-profit organizations. And then again, there was a concern about the time and effort to convert to the direct method. I wondered, and I haven't gone through every single exposure response to the exposure draft, but I was wondering if anyone suggested just deleting it and no longer making it a requirement. So the project timeline, since August, the FASB's accumulated the feedback to their exposure draft. They met with the NAC in September, and they've had 2 roundtables. And during those roundtable meetings, it gave the FASB board members the opportunity to have two-way dialogue with a variety of folks who responded to the exposure draft, really getting more feedback on why folks feel strongly about some of the provisions that have been provided. The board's begun redeliberations, and I believe there's a desire to get some of these easier topics finalized, but there's a chance that some of the more controversial topics may be delayed, and so they may put off doing anything on those topics until much later. So we'll see what happens. I think we're working towards the holidays, so they may slow down a bit. All right, it's time for our second polling question. Just in case you need a little humor for the morning, how do you feel about the requirements to prepare the statement of cash flow on the direct method? First, why? Why would we do this? No one really reads the statement of cash flows anyway. Yippee, the direct method provides some useful information that the users of the financial statements want and need. They're begging for it. We need to make a change. Or no way, it's time for me to retire. All right. Let's see, your second polling question of the day. All right, yep. Let's see, our 43% of us say why. No one reads it anyway. I think that's how it feels. And we'll see. Hopefully we will. Maybe we can get it deleted. We'll see. All right, Sasha, I'm going to turn it over to you to get us started on the recently issued standards.
Great. Thanks, Laura. We are going to spend the next 10 minutes or so discussing a few accounting standard updates. We'll jump right in with revenue recognition. I know this has been a hot topic lately and one that has been discussed quite frequently, so we won't spend too much time on it today, but just wanted to remind everyone that this standard was out there. The goal of the new revenue recognition standard is to develop a single principle-based revenue standard for U.S. GAAP and IFRS, with the overall goal of increasing comparability across industries and providing better disclosures. This standard will impact everyone differently, so it's a good thing to start discussing now. The effective dates for this standard have been pushed back 1 year. I think everyone's breathing a sigh of relief related to that. For non-public entities, the standard will be effective for annual reporting periods beginning after December 15th, 2018 now. In June of 2014, the FASB and IASB announced the formation of the Joint Transition Resource Group for Revenue Recognition, also referred to as the TRG. The objective of the TRG is to inform the boards about potential implementation issues that could arise when companies and organizations implement the new standard. The TRG does not issue guidance. In addition, the AICPA has formed 16 industry group task forces to help develop a new accounting guide on revenue recognition that will provide illustrative examples of how to apply the new revenue recognition standard, with one of the industry task forces being not-for-profit. So far, the not-for-profit entity's Revenue Recognition Task Force has identified a list of potential revenue recognition implementation issues that consist of tuition and housing revenue, contributions, government grants, sponsorships, subscriptions and membership dues, and bifurcation of transactions between contribution and exchange components. So it'll be interesting to see what comes out of those meetings. That's all we're going to touch on revenue recognition today, but let's talk about going concern, which is an update that applies to all entities. Currently, there is no guidance in GAAP about management's responsibility to evaluate whether there is substantial doubt about an entity's ability to continue as a going concern or to provide related footnote disclosures. The amendments in this update provide that guidance. In doing so, the amendments should reduce diversity in the timing and content of the footnote disclosures that are out there. The amendments require management to assess an entity's ability to continue as a going concern by incorporating and expanding upon certain principles that are currently in U.S. auditing standards. This update is effective prospectively for annual periods after December 15, 2016. However, early adoption is permitted, should you choose. Discontinued operations. Topic 205 aims to respond to concerns that too many disposals of assets qualify for discontinued operations presentation. The amendments in this update change the requirements for reporting discontinued operations and update the definition of what is considered a discontinued operation. Under current U.S. GAAP, many disposals, some of which may be routine in nature and not a change in an entity's strategy, are reported in discontinued operations. The amendments in this update require expanded disclosures for discontinued operations. The board concluded that those disclosures should provide users of financial statements with more information about the assets, liabilities, revenues, and expenses of discontinued operations. The amendments are effective for periods beginning in fiscal 2015 with early adoption permitted. Moving on to the next topic, extraordinary items. I know everyone out there is probably having a good time with all of these accounting updates, but this one I find pretty interesting because it's actually part of the FASB's simplification initiative, which is intended to reduce complexity in the accounting standards. This update eliminates from GAAP the concept of extraordinary items. The board heard from stakeholders that the concept of extraordinary items causes uncertainty because it is unclear when an item should be considered both unusual and infrequent. Additionally, some stakeholders said that although users find information about unusual or infrequent events and transactions useful, they do not find the extraordinary item classification and presentation necessary to identify those events and transactions. Eliminating the concept of extraordinary items will save time and reduce costs for preparers because they will not have to assess whether a particular event or transaction event is extraordinary. This also alleviates uncertainty for preparers, auditors, and regulators because auditors and regulators will no longer need to evaluate whether a preparer treated an unusual or an infrequent item appropriately. The amendments in this update are effective for fiscal years and interim periods within those fiscal years, beginning after December 15, 2015. Again, early adoption is permitted for this item as well. Okay.
All right, Sasha.
Let's turn things back to Laura now with consolidations.
Excellent. I went one slide too fast. So consolidations, topic 810. I always ask, why are there changes? And so there were concerns that current GAAP might require a reporting entity to consolidate another legal entity in situations when the reporting entity's contractual rights do not give it the ability to act primarily on its behalf, and the reporting entity does not hold a majority of the legal entity's voting rights, or the reporting entity is not exposed to a majority of the legal entity's economic benefits. And so this eliminates the presumption that if a general partner should consolidate a limited partnership. And I think we see this in our not-for-profit arena sometimes as it relates to investments or joint ventures that we might enter into. The standard itself has some great flow charts associated with it that can help you walk through your individual transaction and determine whether or not this will be applicable to you. This standard is applicable to public business entities for fiscal years or interim periods beginning after December 15th, 2015, and then for all other organizations for fiscal years beginning after December 15th, 2016. And if this is actually helpful for you, early adoption is permitted. The next area relates to debt issuance costs. Again, there's been diversity in practice when it comes to where the debt issuance costs are placed in the balance sheet or the statement of financial position. So sometimes we see debt issuance costs included up in other assets, or in other instances it might be netted against debt. This standard will require debt issuance costs related to a recognized debt liability to be presented in the balance sheet as a direct deduction from the carrying amount of that the debt liability, consistent with how we might do a discount on a debt issuance. So the recognition and the measurement guidance for the debt issuance costs aren't affected by this. You'll still capitalize the same things that you had in the past, and then you'll amortize it over the life of the debt agreement. So this accounting for this is a change in accounting principle, and it will require a retrospective approach. So your disclosures would need to include the nature and the reason of the change in the principles, the transition method that you're using, and a description of the prior period information that's been retrospectively adjusted, and then the effect of the change. So this standard will be effective for years beginning on or after December 15th, 2015. And then again, if it's helpful or you're going through a debt issuance now, you could apply it early. The last accounting update we were going to talk about today relates to fair value hierarchy levels for certain investments measured at net asset value. So currently, our guidance allows us to measure the fair value of certain investments using net asset value per share of the investment as a practical expedient. Investments are valued using this practical expedient, and then they are categorized within the fair value hierarchy based on whether or not the investment's redeemable with the investee at net asset value on the measurement date, or if it's never redeemable with the investee at net asset value, or redeemable with the investee at net asset value in a future date. Right? Those are the criteria that we are using to determine whether or not it's a level 1, 2, or 3. For investments that are redeemable with the investee at a future date, a reporting entity must take into account the length of time until those investments become redeemable to determine the classification within the fair value hierarchy. This update addresses diversity in practice related to how certain investments measured at net asset value with redemption dates in the future. So how are they being classified? And they're finding that there's diversity in how that's being done. So the amendments in this update remove the requirement to categorize within the fair value hierarchy all investments for which fair value is measured using this net asset value as a practical expedient. So we'll no longer have to categorize those. It will also remove the requirement to make certain disclosures for all investments that are eligible to be measured at their net asset value or using the practical expedient. Rather, those disclosures are limited to investments for where you actually use the practical expedient for the determining fair value. So the descriptions about the nature of the investment and how long they're tied up, you'll still have to do those if you use the practical expedient. Let's see. The application of this standard is retrospective, so you will be required to make adjustments to both years if you have comparative financial statements once you apply the standard. Public business entities are required to implement the standard for years beginning after December 15th. And other entities are required to apply the standard for years beginning after December 15th, 2016. We have a sample here of what the change might look like when you do implement the standard. You'll see the mutual funds and the brokerage accounts and common stocks are classified by level, but there will be a line down at the bottom or somewhere in your table that shows investments measured at net asset value. And you'll notice there is not a amount in the leveling columns, but there is one in the total, so this footnote will still tie back to your total investments. Great. I'm going to turn it over to Sasha to give us an update on uniform grant guidance.
Thanks, Laura. We are now going to shift gears to the new Uniform Grant Guidance, which was developed in response to the November 2009 executive order. I know this has definitely been a hot topic over the past 12 to 18 months, so for those of you at organizations where this is applicable, I am sure that you have been quite inundated with this information, but we're going to give you a little bit more to kind of chew on today. Final guidance has been issued that supersedes requirements from certain OMB circulars. This reform impacts federal agencies, non-federal entities, such as states, local governments, Indian tribes, institutions of higher education, and not-for-profit organizations that receive federal awards as a recipient or as a subrecipient. This slide highlights the key sections of the uniform guidance. Due to time limitations today, we are going to spend our time together discussing a few of these areas, which I have highlighted on a later slide. If we are going to cover all of these topics, it might be a 1 or 2 day course, so we won't subject you to that today. But at the end of the presentation, we do provide some links where you can find additional information on areas that we do not cover today. So let's have our third polling question here. And the question is, have you read the uniform guidance? Yes or no? Give you guys about 30 seconds to get your answers submitted. Want to make sure you hit at least 3 of these 4 polling questions in order to get your CPE. Okay, let's take a look at what we've got. So it looks like most of you have not read the uniform guidance, and that could be because it doesn't sound appealing or interesting, or maybe it's not applicable to your organization. So today we will talk about the OMB grant reform background, subpart B, which covers some general provisions, subpart D, which deals with post-federal award requirements, and also what you can do now, and then we'll provide you with some helpful resources. Key effective dates for the uniform guidance. For federal agencies, they implemented policies and procedures by promulgating regulations that became effective on December 26, 2014. For non-federal entities, most of you out there on the call, the new uniform grant guidance is effective for all new federal awards and additional funding, also referred to as funding increments, to existing awards made after December 26, 2014. Early implementation is not permitted, and the audit requirements are effective for fiscal years beginning on or after December 26, 2014. Overall, the intent of the uniform grant guidance was to reduce administrative burden and risk of waste, fraud, and abuse. The uniform grant guidance accomplished this by eliminating duplicative and conflicting guidance. They actually removed 80 pages from the guidance, focusing on performance over compliance for accountability, encouraging efficient use of information technology and shared services, providing for consistent and transparent treatment of costs, limiting allowable costs to make the best use of federal resources, setting standard business processes using data definitions, encouraging non-federal entities to have family-friendly policies, strengthening oversight, and then targeting the audit requirements to be specific to risk of waste, fraud, and abuse. In order to accomplish the benefits we just discussed, the following circulars that are listed on this slide were superseded. So that was a brief overview of the grant reform background. Now we will move into subpart B, which is the general provisions. In subpart B, the word should is used many times. Many have questioned, does this should really mean must? The answer is no. The word must is used throughout Part 200 to indicate requirements. The word should is used to indicate best practices or recommended approaches that the COFR wanted non-federal entities to be aware of, but not necessarily required to comply with. Next is Section 200, 112, Conflict of Interest. whereby the federal awarding agency must establish a conflict of interest policy for all of their federal awards. The non-federal agency must then disclose in writing any potential conflicts of interest to the federal awarding agency or pass-through entity in accordance with the applicable federal awarding agency policy. Subpart B also includes some mandatory disclosures. The non-federal entity or applicant for a federal award must disclose in a timely manner in writing to the federal awarding agency or the pass-through entity all violations of federal criminal law involving fraud, bribery, or gratuity violations potentially affecting the federal award. Let's take a minute now and have our last polling question, which is, have you read COSO? Give everyone a few seconds to submit their answers to see how many of you have spent time reading this fun document. Take a look at what we got here. Wow, more of you out there have read it than I was expecting, so that's pretty good to hear. Your familiarity with COSO will come in handy as we move into discussing some of the items in subpart C, or subpart D, sorry. So with that being said, let's go ahead and move into subpart D, post-federal award requirements. Performance measurements. This area was really beefed up to focus on outcomes, providing more robust guidance to federal agencies to measure performance that will help improve program outcomes. This will then trickle down to recipients of the grants via potential changes in their grant awards. Recipients will be required to use approved standard information collections, and recipients must relate financial data to performance accomplishments and provide cost information to demonstrate cost-effective practices. There is an increased focus on data collection. For the research community, when there is no standard approved form, there is no requirement related to bullet 3 on the previous slide. Lastly, related to performance measurement, federal awarding agencies are required to provide recipients with clear performance goals, indicators, as well as milestones. Let's talk about internal controls for a moment. Subpart D says the entity must establish and maintain effective internal control over federal awards, and the internal controls should be in compliance with the Green Book and COSO. There's the use of that should and not must. While non-federal entities must have effective internal control, there is no expectation or requirement that the non-federal entity document or evaluate internal controls prescriptively in accordance with these documents, or that the non-federal entity or auditor reconcile technical differences between the documents. They are provided solely to alert the non-federal entity to source documents for best practices. Non-federal entities and their auditors will need to exercise judgment in determining the most appropriate and cost-effective internal control in a given environment or circumstance to provide reasonable assurance for compliance with federal program requirements. All right, moving from internal controls into procurement, which is definitely one of the more talked about areas of the new Uniform Grant Guidance. Here's the procurement claw. For those of you that have been reading the Uniform Guidance, they're probably fairly familiar with this claw figure. This claw identifies the 5 different procurement methods, which we will go over on the following slides. Before diving into the methods, I wanted to clarify that all 5 procurement types must comply with the procurement standards in Section 200.318, which can be summarized generally as follows. 1, the purchase complies with the non-federal entity's documented procedures in place. 2, purchases are necessary. 3, open competition. 4, conflict of interest policy. And 5, proper documentation for the purchases. Okay, diving into the actual methods. First one, Purchases of supplies or services under $3,000 are treated as micro-purchases. The purchase orders may be awarded without soliciting any competitive quotations if the non-federal entity considers the cost to be reasonable. The non-federal entity must, to the extent practicable, distribute these purchases equitable among qualified suppliers. For example, a purchase of computer paper in the amount of $2,000 can be treated as a micro-purchase. No rate competitive quotations are necessary for the purchase. A cost or price analysis is not required. However, in accordance with the non-federal entity's written policies, which may include strategic sourcing or bulk purchase arrangements, the non-federal entity must consider whether to make the purchase from any one of a number of office supply stores. Such policies may dictate the purchase of computer paper to rotate among qualified suppliers if they offer the same rates. Second method, purchases under the simplified acquisition threshold are purchases for goods or services meeting the small purchase threshold, which is currently at $150,000. Therefore, all purchases between $3,000 and $150,000 can use the small purchase procedure, which describes the procedures as relatively simple and informal. It states that price or rate quotations must be obtained from an adequate number of qualified sources. It leaves the discretion of the non-federal entity written policy to determine what the adequate number really is, but it must be any number greater than 1. And the methods of obtaining the price or rate quotation are left up to the non-federal entity. For the third method, it relates to for purchases over the simplified acquisition threshold, which is currently $150,000, as we mentioned, the more prescriptive methods of either sealed bids or competitive proposals apply. Sealed bids are publicly solicited with a fixed price contract awarded to the lowest bidder. This is generally preferred when procuring construction contracts. Competitive proposals. The RFP must be publicized. The proposals are solicited from an adequate number of qualified sources, but they don't define adequate. Again, that's up to the non-federal entity to document and determine. Organizations must have written method for conducting evaluation of the received proposals. Again, another reminder to document all of your policies. The contract should be awarded to the firm with the proposal that is most advantageous to the program. It doesn't necessarily need to be awarded to the bidder that's the lowest price. And finally, the last method, non-competitive proposals, which are only appropriate when goods or services are available from single source, there's been a public emergency, after soliciting a number of sources, competition is deemed inadequate, and also the awarding agency expressly authorized non-competitive proposals in response to a written request from the organization. Just naming a vendor in the grant budget or application isn't enough to justify the requirements under this fifth method of procurement. So the nice thing with procurement is there has been an additional 1-year grace period for the effective dates. Originally, it was 1 year after the Uniform Grant Guidance effective date back in December 26, 2014, but that has been extended 1 year, making it December 26, 2016. So there's a little break everyone's getting. Okay, almost on to the last topic for today, subrecipient monitoring. There are documented pre- and post-award assessments. This slide covers the pre-award assessments, which include prior award experience, prior audit experience, staffing and systems, and extent of any federal monitoring. Post-award monitoring has a few more steps, which I won't walk through as they are fairly self-explanatory. The key to remember is to ensure controls around subrecipient monitoring are designed, implemented, and operating effectively, and to ensure they are documented. This slide just clarifies briefly that when subawards are made prior to December 26, 2014, and some are made after December 26, 2014, the effective date for the Uniform Grant Guidance for the subawards is the same as the effective date of the federal award for which the subaward is made. The requirement for a subaward, no matter when, flows from the requirement of the original federal award from the federal awarding agency. Where to find major areas of change? Internal controls. While we didn't dive too much into this today, we did visit the highlights of this adjusted design. I recommend you familiarize yourself with the resources that are available. We touched on procurement and we touched on subrecipient monitoring, but we didn't talk too much about direct and indirect costs and time and effort. These are part of subpart E, which we didn't have time for, but if you visit the link we provide at the end of the presentation, you will find more information. So, what can you do now? There's always something that can be done. First, there is no substitute for a deep dive. Review your policies, procedures, your structure. Review the guidance and see if there are changes that impact your organization. Determine if current policies and procedures address these changes or if current policies and procedures need to be updated. Ensure you are keeping inventory of which grants are affected by the new Uniform Grant Guidance. I also recommend creating a team to address these steps. Here are some summary points of different tasks team members can perform. It's imperative that the individuals involved in this area are kept informed of the policies and requirements. If your organization's capacity allows, it's definitely recommended to establish a grants administration program. Here are some links to helpful resources that can provide more detail on what we covered today, as well as information on topics that we weren't able to discuss. As always, feel free to reach out to us here at Moss Adams if you have any additional questions, and we'd be happy to provide you information or point you in the right direction. All right, moving on from Uniform Grant Guidance, just one last thing we wanted to put in front of you. We knew we wouldn't have time to discuss these items today, but here are a few other active projects that are out there that we wanted to ensure you are aware of, if you aren't already. Leases, business combinations, financial instruments, the Simplification Initiative, which I mentioned briefly earlier, as well as the Disclosure Framework. Keep an eye out for more on these projects down the pipeline. We now have a few minutes left for some questions.
And Sasha, you had a couple that you had received earlier. Do you want to go over those?
Sure, I'd love to. So the first one deals with procurement that I see, and it says, do the requirements for competition in the methods of procurement apply to each individual item that is purchased, or may I apply them to a broader procurement decision or a group of items that I'm purchasing? And the answer is the requirements for competition can apply to the broader procurement decision, so not necessarily just to an individual item. The procurement standards explicitly encourage non-federal entities to build into their procurement policies practices that consolidate the procurement purchases and, where appropriate, provide guidance to make the most efficient use of federal funds. So yes, you can apply the procurement method to a group of items that are being purchased. See, I think I've got one more here related to procurement that it's a good one. So it says, does the uniform guidance require non-federal entities to limit credit card or charge card purchases to a particular threshold amount? And that's a good question, and one that I've heard a few times now. And no, the guidance provides requirements for the internal control framework that surround the purchases and the procurement side, but it doesn't provide any specification as to whether the entity decides to use cash or credit cards or checks or say anything else related to the actual payment method.
Thanks, Sasha. Hey, Pam, can we turn it over to you to wrap things up?
Yeah, no, sounds great. Again, thank you again to Sasha and Laura and to all of our attendees for participating in today's presentation. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive credit. And you can find that. That's located in the icon that looks like a file folder of the webcast console. If you participated as an individual, you should be able to view your CPE progress in the certification widget of the webcast console. If you met all certification requirements, you should see a download icon in the bottom right-hand corner of the widget window and be able to download a PDF copy of your CPE certificate from there. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. Also, please visit our website, mossadams.com/NSP, to learn more about future webcasts, subscribe to our email alerts, and find on-demand versions of some of our previous webcasts. And finally, here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete the survey as your feedback is very important to us. Thank you again for joining us, and we hope you'll join us again next time.